Good morning, everybody, and welcome to today's webinar. Just quick introduction to myself. I'm Matthew Trebilcock. I'm the head of pensions at Gloucestershire. I'd just like to start by thanking Will and Pella from our employer team, and we have Will on screen with us today, for arranging today's webinar with ourselves. And what I'd also like to do is welcome Julie and Victoria from Hymans Robertson, the funds actuaries, who will be talking to you today about preparing for the 2025 valuation. It only seems a few minutes ago since we were talking to you about the 2022 valuation, the preparation, and then obviously the outcomes from that. And we now seem to be running straight forward into 2025. So Julie and Victoria will talk to you today and set a bit of the scene from that side, and also about how we need to work together to actually deliver the 2025 valuation as a fund, as an employers from that side. So just a little bit of housekeeping from our side for today's webinar. Julie and Victoria will run through a presentation with yourselves now. What we would ask, please, is if you could put your questions in the chat function, and at the end of the presentation, myself and Will take those questions through to Julie and Victoria at the end of that. So with no further ado from myself, I will now hand over to Julie and Victoria to take you through the preparation of the 2025 valuation. Thank you.
Thank you, Matthew. Good morning, everyone. It's lovely to speak to you all this morning. So, as Matthew said, I'm Julie West. I'm the fund actuary. I've advised the Gloucestershire Fund for well over 15 years now, and have gone through numerous valuation cycles with the fund. They do come round really quickly, but each time we do a formal valuation, there's always a new set of circumstances and a new environment that we're working in. So the purpose of today is really to give you a bit of a background about what it is we do at the valuation. Well, that is our day-to-day job. We think about the LGPS every single day. We recognise that for a lot of you, you may only be thinking about your employer's participation in the LGPS. Once every 3 years when we come round to this process. So some of you might be really experienced, some of you might be new to this. Please take the opportunity to ask us questions as we go. So we'll cover a little bit about what do we mean when we talk about the actuarial valuation. What is it we do? We did the last formal valuation in 2022, so we'll be looking at what's happened over the last 3 years, and thinking about the environment within which we're operating in 2025. The kind of key thing will be, what does this mean for you all in terms of your own participation in the fund? How might that translate into contribution rates? And then I'll pass on to Victoria, who will talk you through your part in that process. So we very much rely on that three-way communication between us as the actuaries, the fund officers, and all of the employers to make the project a success. And finally, a little bit on the timeline, so what you can expect to see and when. So to start us off, what is an actuarial valuation? So we go right back to the start and we just think about, how does this pension fund work? So the fund collects contributions, so from the employers and the employees, and invests those contributions in line with the fund's investment strategy. So the fund decides how it's going to invest those assets, with the aim of paying out pensions to all of your current employees and past employees and the current pensioner members of the fund. The really important thing about the LGPS is what's known as a defined benefit scheme. So that means that the benefits that those members earn are defined with respect to regulation. So they know in advance how much benefit they're going to get. It's determined in line with what they've earned and they've been in the fund and how long they've been in the fund. And what the fund's aiming to do is to make sure that there's enough money there through that combination of contributions and investment returns to pay out those benefits. So our job as the actuary is to make sure that all of those sides of that equation balance. So really we need to make sure that the employee contributions, the employer contributions, and the investment returns will all be sufficient to make sure there's enough money to pay out those benefits. So the important thing there is that, as I've mentioned, the benefits paid out to members are defined by regulation. So as an employer, you can make them more or less. Also, the employee contributions are fixed. That's a question that comes up quite often at evaluation, is the employee contribution rate changing? But no, the employees' contributions are determined, again, by regulation and are dependent on how much their salary is. So we've only got the balancing item of the two things, employer contributions and investment returns. And our job as the actuary is to set an appropriate level of employer contributions to make sure there's enough money in the fund. So as I've mentioned, the most important output from the valuation is the calculation of the employer contribution rates. But it's also an opportunity to look at the fund as a whole. So we do a valuation every 3 years because it's defined in legislation that we have to. The other public service schemes, the government actually looks at them every 4 years, but the LGPS is on a 3-yearly cycle. It also gives us an opportunity to look at what has happened in the fund versus what we have assumed to happen. So when we are thinking about how much benefits members will earn in the future, we make a series of assumptions, and we check that those assumptions remain valid or adjust them as necessary, depending on what's happened within the fund. As part of the process, we also review a document called the Funding Strategy Statement. That comes out later in the year, comes out to all employers for consultation. And really that is the fund's rule book of how it will collect that money to fund the pension benefits. So look out for that when it comes later in the year. You do have an opportunity to comment and discuss with the fund. And that's really the document from then on for the next 3 years that we rely on to make all funding decisions. And finally, it's also an opportunity for us to check in on the fund. So is the fund in a good position? Or do we have a bit more cause for concern? So it's a bit of a health check on the fund. We think about how much money the fund has now and how much benefits we know the fund has to pay out already. It's a bit of a health check on the current position of the fund. So while the calculation of employer contributions is the key output, it's also a big exercise in the general risk management of the pension fund. So when we think about the formal valuation, it can be really easy to look at what we call the funding level. So when we talk about the funding level of the scheme or the solvency of the scheme, we're thinking about how much money does the fund have now, the assets, and what is the value of the benefits that have been earned so far. We call those the liabilities, and we compare those two things to each other. So if you had a funding level of 100%, you would have exactly the right amount of money just now with an allowance for future investment returns to meet all of the benefits that have been earned so far. But what makes the LGPS a great scheme to be part of is that it continues to be open to new entrants. And what that means is that not only are we thinking about the benefits that have been earned so far, we're also thinking about all of the benefits that will continue to be earned in the future. And as I mentioned right back at the start, there's only two ways that we can fund those benefits, two levers that we can pull, the future investment returns or the value of future contributions. So the main job as part of the valuation is to strike that balance between contributions and investment returns. If we place too much reliance on future investment returns, it would make contribution rates really low. There's also a much higher risk that that's not borne out in practice. And we could also turn that round and we could be really prudent with our value of investment returns and set that bar really low, but in turn that pushes up contribution rates and can make the scheme unaffordable. So really it's about a balance between investment risk and affordability. So the outputs that you'll see coming out of the valuation will be the contribution rate. The majority of that contribution rate will be what is known as the primary rate. That's the amount of money we need to pay for the members who continue to earn benefits, and the funding level, and that's that comparison about assets now and benefits earned today, which is really only a backward-looking measure. It doesn't think about all of the benefits that will continue to be earned in the future. So how do we do the valuation? So the fund will supply us data for each member. So that includes the current members, the active employees, what we call deferred members. So any members who've earned a benefit in the scheme but have left employment with a relevant employer, but aren't eligible to receive their pension yet. So we've got actives, deferreds, and our pensioner members who are currently in receipt of a benefit. We also say a set of assumptions. There are two types of assumptions, financial and demographic assumptions. So the financial assumptions influence how much benefit we expect to pay. So a financial assumption, for example, is a future level of inflation. And as all the benefits are linked to inflation, that influences the amount of benefit that we expect the fund to pay out. A demographic assumption influences the timing of the benefit payments or how long they're paid for. So the most important demographic assumption is life expectancy, when we think about how long any pension benefit that comes into payment for, how long that will be paid for. So we have a full set of assumptions that we review with the fund's officers to form the part of the valuation process. We also we set a funding strategy. That's what I've mentioned earlier. We set out in the funding strategy statement, and that works hand in hand with the fund's investment strategy statement. So the funding strategy statement sets out the amount of contributions that we aim to gather across all of the fund's employers, and investment strategy sets out how the fund will invest its assets. And the last piece of that puzzle is thinking about actually what benefits will be earned. Which generally is a fixed amount. We know what the LGPS regulations tell us, but over recent years we've had a few uncertainties. So, for example, the McLeod remedy meant there was a little bit of uncertainty about how much benefit would be earned by some members of the fund. So we've got a whole set of inputs, so data, assumptions, funding and investment strategy, and the benefits, and we put that through our models. And what comes out from that process is for each employer in the fund their own results. So you'll each receive a schedule that sets out your own position in the fund and your own contribution rate. That could be a really useful thing to keep for your auditors, for example. And that sets out how we've got to your contribution rate in the fund, what your funding position is, and also how your funding position has changed. So any movements, positive or negative, since the last valuation. We also revise the funding strategy statement, so it will be changed for things like any changes in assumptions that we've made, or also any changes in the way in which the fund intends to gather contributions across all of its employers. And then that's all summarised, which will be the end of 2026 into by March 2026 into a final valuation report, which sets out the position of the fund as a whole. But importantly, at the end of that valuation report is a certificate called the Rates and Adjustment Certificate. And that is the kind of legally binding framework that sets out the contributions that we're expecting employers to pay in the fund over the next 3 years. So what has happened since 2022, so our last valuation date? So last time round, the fund had a little bit of a surplus. And what I mean by that is that the assets were slightly larger than the liabilities, so the current benefits earned so far. So a surplus of £0.28 billion. The average employer rates across the fund, so the average total rate was 27.8%. And that was split into a primary rate of 21.8%. So that was the amount on average that employers are paying for benefits that continue to be earned. and an average secondary rate, which is really just the balance between the primary rate and the total, of 6%. But actually, that's really just a headline figure. That's the numbers that go in the valuation report. But really, the fund is the collection of all of its employers, and all of the employers' funding levels and contribution rates will look different to that back at 2022. So that's where we started from. How does it look now? So on this slide, the pink lines are the liabilities, so the benefits earned so far. And you can see that value has dropped. There was a big spike down, and then it's kind of leveled off over the rest of the intervaluation period. But since 2022, the value we're placing on liabilities are down, and I'll come back to talk about that, why that is in a minute. And the green line is the assets. So the assets were fairly stable, so we're kind of lagging a little bit behind where we'd hoped they would be over the start of the intervaluation period, but have started to pick up. Okay, so assets are up, liabilities are down, which means an improvement in the funding position across the whole fund since 2022. So asset returns have just about exceeded expectations after a bit of a slow start. We have also seen some kind of major changes in the economic environment over that period of time. So interest rates have risen. So if you think back to where you were at 2022, if current accounts, for example, were paying almost close to 0% interest on any cash balances. And now I'm sure many of you will be aware that you can earn something round about 4%-ish on any cash in your current account. So that feeds through into our expectations for what we think the fund's assets in their totality will earn. So if you can earn a high amount of money on cash, we similarly expect to earn more investment returns on the asset classes that the fund invests in. So things like equities and bonds and property. So we've seen rising interest rates over the period of time. We have also seen high inflation, which is typically not good news for the funding level, because high inflation means higher benefits are paid out to members, so liabilities are higher, but that has been more than offset by the rising interest rates. And as I've mentioned, those rising interest rates lead us to place a higher expectation on the future investment returns of the fund. That in turn reduces the liabilities. So what we'll see this time round is improved funding positions. And that is largely as a result of an expectation of higher future investment returns. So if we expect to get more investment returns in the future, we can hold less money now. So in effect, you're expecting your assets to do more of the work for you in the future to fund those members' benefits. Okay, so generally we'll see higher funding levels. That's as a result, in the majority, because of an expectation of higher future returns. But each employer will see their own circumstances reflected in their valuation results. So while that's good news, the LGPS, it remains an open scheme. Okay, so we've not got to being 100% funded and we can think that's job done, the fund is, we don't have to think too much about the current environment anymore. As an open scheme, we have to make sure there's still enough money coming in to fund those benefits, and we're still thinking about what those future investment returns need to be to make sure there's still enough money there to pay for all of the benefits that have been earned in the past. So with an open scheme where we expect to be paying members' benefits out 80, 90 years in the future, there's still an exposure to a lot of risk. So we're starting from a good place, we're starting from a higher funding level, but part of our job at this valuation will be thinking about how do we manage some of these risks. So if we think about the market, so there could be future high inflation that influences members' benefits. If there was a reduction in interest rates, for example, that might affect our assumptions for future investment returns. And also we have seen quite a lot of market volatility also. So thinking about being cautious about our expectations for the future. The fund also needs to think about cash flow. So the money it gets in from contributions versus the benefits that it pays out. And managing if the benefits out are higher than the cash flow in, that can mean you've got a slight change in investment strategy, because you need to make sure that the fund are generating income from other sources to make sure they can pay those benefits. We need to think about how long members live for. Will that be longer or not as long as we had previously assumed? What are the trends in longevity? And how might life expectancy change in the future? And that has also been quite an area of uncertainty over the last few years, particularly coming out of the COVID pandemic and understanding the long-term impact on life expectancy. As a profession, we also are obligated to make sure our clients think about climate risk. As a long-term investor, the LGPS is exposed to the risk of climate change through what might happen to investment returns, how climate change could influence how long members live for, inflation, for example. So we also have to build in some element of climate change risk analysis into the advice we provide the fund. And also thinking about covenants or the strength of all of the employers. The funds have an obligation to make sure that each employer pays its own way, and they want to, as far as possible, make sure that each employer's asset share is enough to pay for their own benefits, and there's less chance of those benefits ever having to be funded by another employer in the fund. So they also manage the covenant of each employer, and we try insofar as we can to make sure that the contribution rate for each employer reflects their own circumstances and any risk associated with their own circumstances in the fund. What is good about this valuation is that the position that the fund are in with a surplus now gives us an opportunity to manage some of that uncertainty. So I mentioned earlier, when we're setting contributions, we're having to think about how to balance that future risk of investment returns not being enough versus stability or affordability of contributions. And the balance of that line is a key funding decision. As I mentioned earlier, also the funding level in itself, so while the funding level will look really healthy this time round, that is only a backward-looking measure. It's only thinking about the benefits earned so far. We know that the majority of benefits will be earned in the future. And so really our focus and the aim of this valuation will be on getting the right balance between affordability of contributions for the employers, but also making sure that we're able to do that in a way that's sustainable. So, for example, it's not a successful outcome if you have a significant drop in contribution rates, only to find in 3 years' time that they have to go back up again. So we try to set a long-term strategy that we can hold for as long as we are able to reflect an employer's circumstances. So really trying to keep contribution rates as stable as we can. Always at evaluation, there's things that are working for us and also in areas of uncertainty. Some areas for caution this time round. So while I've mentioned that we have an expectation of future investment returns being more positive than they were 3 years ago, we have to think about what would happen if that slowed down. So what would it look like if we were back in 2022 doing this valuation? Inflation will always remain a risk in the LGPS. So if we've got higher than the sort of long-term Bank of England's 2% target, that in turn influences members' benefits. And we also have to think about the government's policy also. So the government in recent times have been very interested in the LGPS, particularly in the the assets that it holds and how it invests those assets. So the government are particularly keen to see, for example, investment in the local area. And so there's a consultation underway just now that may influence some of the ways in which the funds invest their assets. So we've got a little bit of caution as we go into the valuation process. But also some areas for optimism. So and the first thing on here is really will be the kind of key message from this valuation. So the fact that we're in a higher interest rate environment means that we have a higher expectation for future returns, and that in turn puts downward pressure on contribution rates. And so we do expect across the board in the fund that there will be reductions in contribution rates as a result of this valuation. The funds have also had good investment experience, particularly like over the longer term. So there was a fairly slow start to investment returns after the 2022 valuation. It's been more positive in recent months, but if you look over the longer term, the LGPS as a long-term investor has been really successful in doing that. And also I mentioned earlier that one of our inputs to valuation is the benefit structure, what will benefits earned, and that's becoming more certain as we go through each valuation cycle. So there was a bit of uncertainty round about McLeod, and that's now been resolved within the data that we get from the fund. And a couple of things that we know are on the go, but we don't know quite how they will influence the valuation yet. So one was the pensions review. So I mentioned that the government are quite interested in the LGPS just now, particularly in its assets. So they're thinking about that. We don't know what that will mean in the long term. The government actuary also carries out a separate valuation. It's called Section 13. And they carry out a separate valuation of the fund. And really what they're trying to make sure is that when the fund makes decisions about the funding of the scheme now, it's not passing on a problem for future generations of taxpayers. So their aim is really to make sure that current taxpayers, in effect, pay their way towards their contribution to the scheme. And we talk about that in terms of being intergenerational fairness. And that is one thing that we think about quite a lot when we're setting funding strategy. And finally, which we've seen a little bit of this, but not too much within the fund, is employers who are taking this as an opportunity to leave. So not all employers have to be in the LGPS. So the majority of employers that are in the LGPS have to be in there by law. But there's other employers in there who are taking the opportunity to exit while the funding position looks quite good. Generally, though, it is a positive outlook for the 2025 valuation. So I've mentioned that when the funding position is improved, we have more of a surplus, so more of an excess of assets over liabilities than previous valuation cycles. And when you're in surplus, there's four things that you can do. You can reduce employer contributions. You can think about reducing risk in your investment strategy. So you can say, I don't need as much risk, so it will reduce future volatility in asset returns. You can look for a higher level of prudence, is the word that they actually would use. So you can say, actually, when I'm setting contributions, I want to be more sure than it was previously that those contributions will be enough. We would call that an increase in prudence, and we'll come back to talk about what that means. And also you can say, actually, I've got this surplus just now. I want to hold on to some of that as a bit of a buffer in the event of future adverse outcomes. So we're in quite a volatile market just now. There's a lot of geopolitical risk also. The fund can consider holding on to a bit of that surplus to offset any future uncertainty. And actually, from the work that we've done so far with the funds to try and set a plan for how we'll calculate contributions, we've looked at the majority of these things. So the funds separately will think about the investment strategy, but we expect this valuation for most employers that we can reduce contributions whilst also increasing prudence. So being a bit more sure that that lower level of contributions will be enough, and also hold on to a bit of the surplus. And the reason that we want to hold on to a bit of that surplus is because of that intergenerational point that I mentioned on the last slide. If the funds were to drop contributions too far and use up all of that surplus, you are storing up a problem for future generations of taxpayers who would ultimately have to pay more in the fund. So holding on to a little bit of that surplus, it also earns investment returns and helps to keep contribution rates lower. So all in all, we expect it to be quite a successful outlook, in that we can, from a funds perspective, they've got a little bit less risk in the fund, but also from an employer perspective, we expect that to translate into a decrease in employer contributions. So last slide from me, the contribution rate outlook will depend on what type of employer you are. So if you're in the fund for a short amount of time or are a long-term employer, a council and academy, for example. So for our council employers, we've already gone through the exercise to set contributions, and all of our council employers, we've planned a decrease in contribution rates, and in quite a significant decrease for some. For our academy schools and also our colleges, and we're currently considering whether we can operate what we call a stabilised approach. So can we give a bit of future certainty about contribution rate movements to that employer group? So as long-term employers in the fund who have a guarantee from the Department of Education, are we able to give some contribution rate relief now, and also balance that with a bit of longer-term stability in the funds? And the aim of that is to bring the schools and the approach to setting schools contribution rates a little bit closer to the approach taken for Gloucestershire County Council and all of its LEN and maintained schools. And for all other employers in the fund, it will be dependent on individual circumstances. We will be, again, trying to balance a decrease in contribution rate with managing risk. We don't want to decrease contributions too far that in return leads to the likelihood they have to go back up again. But we are expecting the outcome for most of the employers to be a decrease in contributions. Okay, so with that, I will pass you on to Victoria and talk about, as employers, your part in this process.
Thanks, Julie. Good morning, everyone. As Julie mentioned, I'll now cover a bit about your role in the valuation process, and specifically the data we need from you and how you can help make the valuation the best possible experience for both yourselves and the fund officers. So firstly, we'll take a look at the data we need to carry out the valuation. And this is really important as your data directly impacts the contribution rate that we'll calculate for your organisation. If you just move on to the next slide, Julie, there. Thanks. Yeah, so to do this, we require all the kind of standard pieces of data that most of you will likely be familiar with providing to the fund on a regular basis, such as notice of any leavers, any new joiners, salary changes, and just any general updates to your employees' information. And there's a link at the bottom of this slide which takes you to a helpful video prepared by the fund which walks you through how to complete your year-end return. And even if you're not new to the process, this video should still be helpful, as the fund have slightly updated their template spreadsheet this year. So please do take the time to watch that back if you haven't already. The data we received from Matthew and his team at the fund is some of the best we see each valuation, which is testament to both yourselves and the fund officers for all your hard work in achieving that. And this is really helpful not only for us as the actuaries, but also for the fund, as it reduces the time spent on data queries, and ultimately it benefits you as employers, as it means we can deliver the results of the valuation to you much quicker. So we're really keen to maintain those high standards again at this valuation. So please do engage with the fund officers to assist with any data queries, as the better the data we hold, the better the outcome for you. So there are three main types of data that feed into the valuation calculations, and all of which is provided to us by the fund, who regularly receive this data from you. Firstly, we have membership data, which includes data about each employee in your organisation, such as salary information, dates of birth, postcodes, as well as the details of any of your ex-employees that may now be deferred or pensioner members in the fund. And this membership data is used for calculating the benefits due to each member, or in other words, your liabilities that Julie spoke about earlier. Then we have cash flow data, which is a record of all the cash flows that have been paid in and out of the fund since the last valuation at 2022. And we receive this data from the fund on a monthly basis, broken down at employer level, and that is used to calculate your own share of the fund's assets. And lastly, looking at employer circumstances. So we hold a large database of information about each employer in the fund, which is used to help us understand the most appropriate treatment for you at the valuation. So if your circumstances have changed since the last valuation at 2022, then it's really important that you let the fund know. So for example, you might have closed to new entrants, you might have had a large bulk transfer of staff in or out, or you might be facing affordability concerns, and all of these things may mean that we adopt a different funding plan for you at the valuation, so please do make the fund aware of any changes. And as you can see from the flowchart on this slide, all of this data impacts different parts of the valuation, but they will ultimately all come together and feed into the calculation of the contribution rates for you at this valuation. Now, we rely very heavily on the data provided to us, and much kind of like most things in life, the end result is often only as good as what you put in. So it is imperative that this data is of high quality. And so here we just have a few quick examples of even how just the smallest errors in the data can impact the calculation of your contribution rate at the valuation. So here is an example of an active member where their full-time equivalent salary is £10,500, but it has been misstated as £15,000. So just a simple swap of the 0 and the 5 there. And you can see that this increases the member's liability by about 50%. As having a higher salary will mean we expect this member to have a higher pension, which in turn would give rise to a higher contribution rate being calculated for you. Similarly, in the next example, here we have a pensioner member whose date of birth has been misstated as 1965 instead of 1956, which makes the member 9 years younger than they actually are. And this would mean that we would assume their pension needs to be paid out for a longer period of time. And again, this error would increase the member's liability by roughly 50%, and would result again in a higher contribution rate being calculated. And it's not just the valuation itself that this data will feed into, and we also use your data and the results of the valuation for other exercises such as the IAS 19 or FRS 102 accounting reports, any new academy conversions, and just general ongoing risk management. So it's very much in your interest to make sure you provide as accurate data as possible. And lastly, just to summarise what you can do to support the valuation process. Firstly, review the data that you hold for your members and ensure it's up to date and accurate. Make sure that you submit your year-end returns on time. I believe the deadline is 30th of April, but I'm sure sooner rather than later would be appreciated by Matthew and his team. And make sure you reply promptly to any queries that the fund officers may have. They're working to get best outcomes for you, so please do help them as much as possible. Keep yourself informed. So coming along today is a great place to start. So it's good to see lots of you on the call this morning. There will likely be another employer forum later in the valuation process where we can share more with you on the actual valuation results. And the fund also issue regular communications throughout the year. So please keep an eye on those so that you can get in touch with the officers if there's anything you're not sure about. And lastly, we would ask that you actively engage with the fund officers around your own circumstances that I mentioned earlier. So if there is anything affecting your organisation, the earlier we know about that, the better, and the more appropriate a funding plan we can put in place for you. And finally, as always, please do ask questions throughout the process, and particularly if this is your first valuation. You can reach out to the fund or even to us. We're both happy to help and want you to have the best possible valuation experience. So staying engaged will benefit everybody. So I'll now pass back to Julie, who will wrap up the presentation today by taking a look at the valuation timeline for 2025.
Yeah, thanks, Victoria. So we're at the start of this timeline just now with our Meet the Actuary sessions. What this doesn't show is actually the amount of work that we've already done with the fund already. So we've been thinking really about this valuation since the start of 2024 and thinking about in particular the contribution rates for the councils. So lots of work is underway already, and really the aim of doing all of that work in advance is, as Victoria said, is to make it as good a valuation experience for the fund and all of its employers as we can. So we've got a lot of the planning and organising done so that when we get into the valuation itself, it's a straightforward process. So the actual calculations for the valuation will begin at the point that we receive the membership data from the fund. So we expect that to be in the summer this year. And that's why it's really important, as Victoria said, to get your year-end returns in on time. And the sooner that they are in, the sooner the fund officers can get that data to us, and we can start work on that process. We will be communicating how the whole fund looks round about early autumn this year. But that is really just the whole fund position. And as I mentioned earlier, that whole fund position really is just the sum of all of the individual employers. So the whole fund position is very much a kind of headline figure that will be communicated. But for employers, the piece of interest will come quickly after, which is the individual employer results. So we expect those round about October, November time this year. So you'll each receive your own results, and we will communicate as far as we're able to in advance about if we know any more specifics and any more details about how your contribution rates may look, and we're able to confirm that, we will do that as early as we can. So when you get those employer results, you'll have an opportunity to ask any questions, either of the fund or to meet with us to agree those funding plans. Also later in the year, the funding strategy statement will come out for consultation, and that consultation period will begin. And it usually closes in January 2026. So it gives the employers time to review that policy and come back with any updates or questions, and for those to be reflected in the final funding strategy statement that is signed off at the end of the project. At the start of 2026, we will be drafting the final valuation report, and that rates and adjustment certificate. So that will have all of the finalised rates in it, and that all must be signed off by 31st of March 2026. So the valuation date itself, 31st of March 2025, we have a year to complete it, but we hope that the majority of that work will take place over the end of this year. So data will arrive in the summer, and we'll do employer results over the autumn, and with an aim of having those all agreed by the end of 2025 and reflected in that final valuation report for sign-off by 31st of March 2026. So we'll keep in touch as we go, and as Victoria said, feel free to ask us any questions as we go, reach out to the fund and keep informed as we go. And likewise, we'll be sharing any relevant updates to keep you informed of the progress of the valuation. So thanks very much, everyone. With that, I will pass back to Matthew.
Thank you very much, Julie and Victoria, for that. I don't know if you might want to stop sharing your slides now so people can see us a little bit more. So again, if there's any questions, please put them into the chat. We've got a couple there. So I'll start off with the first one. So Julie, from Helen on this one, it may be you or I on answer this one, but I'll throw it to you first. Does the valuation take into account the potential impact of local government reorganisation, which is obviously something that is facing us in Gloucestershire?
Yes. So the quick answer is no, it doesn't, because we don't know yet how that will look. So in the event that there is local government reorganisation, there will likely be a recalculation of contribution rates for affected employers. So we have that on our radar that might happen, but until we know for sure that that's going ahead, we can't assess the impact of that at this time.
Okay, thank you, Julie.
Also from Alex Garforth Cox, and they say, why is there a primary and secondary rate, and what is the difference between the two?
Yep, so the primary rate is, so it's defined in regulation, that the primary rate is the contributions payable in respect of benefits that will be earned in the future. So if you think about each one of your employees over the next year, they'll earn that year of pension benefit. So the primary rate is only paying for that. The total contribution rate is how much you have to pay for benefits earned so far, plus any adjustments that you need to make to that if you have held too much money or not enough money. So if you're in surplus or deficit, that would influence your total rate. So from the calculations we do, we calculate the primary rate in isolation, but we also calculate the total rate. So thinking about all the benefits earned so far and all the benefits that will continue to be earned. And the secondary rate is just the balance between those two things.
Okay. Thank you, Julie. There's a couple through here. Some of them might land in my direction as well. But the first one I'll ask is, do the new rates come into effect from April 2026?
Yes, 1st of April 2026 for the 3-year period thereafter.
Thank you. Next one, supplemental to that was, if we use GCC payroll service, will they provide the year-end return? The simple answer to that one is yes. What we actually have as being part of GCC is that we have the ability to be able to download that information directly. However, when there are queries, we will come out to you as an individual employer to actually help us resolve those particular queries. So it is one of the advantages of using GCC payroll if you're an external employer, because we get direct access to that data from that side. There's another question about this, and Julie, you might want to answer this one, or I might do as well. Is just on this one. Well, I'll take this one. How independent is the fund's investment strategy? Does it bow to government pressure on investing in the UK or certain sectors? Maybe it will be interesting to get your view on that first, Julie.
Yeah, of course. So yeah, the fund go through a really rigorous process to set investment strategy, and take independent advice on that also. So the fund does work with an independent investment advisor and also seeks support from external consultants also. So the setting of investment strategy is an independent thing. However, the government do say, and this may, I guess the strength of this might increase over time. The government have said, for example, that that local authorities must invest their assets through a pool, and which the fund do. So the funds work with the Brunel pool to make sure that they're getting really value for money in terms of the cost of that investment advice, and are meeting really, I guess, the aims of what the government are looking to achieve there, which is the economies of scale of bringing investments together. So the fund sets its investment strategy independently, but also does have to respond to what the government are requesting.
And I think I'll just follow up on that before we'll ask the next question, is that we have we are undertaking an investment strategy review as part of this process. There will be a consultation and there will be information coming out to you as employers around the investment strategy and the investment strategy statement over the next few months leading into this, leading into that particular side. So hopefully that helps. Will.
And Helen Bojanowska asks another question. How much progress has been made on decarbonising investments, and how is the risk of climate change assessed?
So I'll let Matthew answer the first bit of that. On the second bit about assessing climate risk, we do that in a couple of different ways. Part of the work that we do when we are setting contribution rates are we look at a full range of future scenarios that may happen. And then we consider in those scenarios what would happen if things went really bad, so the kind of downside scenarios. We also link how those may look in a kind of as a response of a climate change event. So we kind of, if you like, stress test the contribution rate setting approach for very extreme examples, and we check that it remains appropriate. And we also do what we call a narrative-based approach. We talk about what would happen if there was a very specific event. In particular, in the case we look at a global food shock, and how might that map through to the investment returns that the fund receive? How might that map through to, for example, inflation? How might things like the government policy, the government reaction to that event influence the outcomes? And we map through a path through those future scenarios and look at what might happen to the fund in those scenarios. So analysing climate change risk, it is very much a rapidly evolving area of science. We did some work on this back at 2022. We've made that approach more refined at 2025, but we also expect that will continue to evolve as time goes on, and there starts to be a bit more guidance on the ways in which the fund can report that more widely. So lots of work goes into climate change. It's really looking at the impact climate change might have on future scenarios, and understanding how the fund would look in those scenarios.
On the first part of the question, how are we progressing? The fund has a responsible investment policy. We have a net zero ambition of 2045. There are certain targets around decarbonisation against our equity investments and the whole of the portfolio by 2030. We monitor those on an annual basis. We are operating to those targets and we should be meeting those targets. Full reporting is done and available through the website, and we do that once a year in terms of that decarbonisation and the carbon intensities of the actual investment portfolio itself. We have also adopted reporting against the Task Force for Climate related financial disclosures. We are still waiting regulation to come through for that, but as a fund we wanted to be proactive, and we are actually reporting against that framework as well, appropriately. So we are making progress, and we do monitor it on an ongoing basis and work through. And again, as part of the investment strategy, we will also be passing out the latest responsible investment policy as part of that consultation as well. If there are any questions that do come to people's minds, please do email us. The easiest one is the generic email inbox, which is pensions@gloucestershire.gov.uk, and we can make sure that your question goes to the right individual to come back to you or any answers from there. I'll just say thank you very much for attending today. As Will said, it will be made available as a recording from that side for you to peruse back at your leisure, and we will be in contact further as we go through the process in 2025, and we look forward to working with you for the outcomes. Thank you very much.